Here is the biggest lie in Canadian personal finance. You need a lot of money to start investing. You have probably heard some version of this. Maybe you believed it. Maybe you still believe it. You need to pay off all your debt first. You need to save up a few $1,000s before it is worth it. You need to understand the market before you put money in. You need to wait until you are making more. Every single one of those beliefs has a cost, and that cost compounds every month you wait. Here is the truth. A Canadian who starts investing $25 per week at age 22, $25, the cost of 2 takeout lunches, and never increases that amount, never times the market, never picks a single stock, just buys the same ETF every week for 40 years, ends up with approximately $590,000 at 8% annualized return. The same Canadian who waits until age 32 to start, giving themselves 10 years to get ready, ends up with approximately $257,000 at the same return. The cost of waiting 10 years to start investing $25 per week? $333,000. That is not a motivational poster number. That is the compound interest formula applied to a 10-year delay in a $25 weekly investment. You do not need a lot of money to start investing. You need $25 and a Wealthsimple account. This video shows you exactly what to do with both. Let us run the numbers on amounts that most Canadians consider too small to bother with. Because the math is more powerful than most people expect, and seeing it in real dollars changes the psychological relationship with small amounts. $10 per week, $520 per year, at 8% annualized return over 30 years, approximately $78,000. The person who invested $10 per week for 30 years contributed $15,600 in total. The investment grew to $78,000. The growth, $62,400, came from the market, not from additional contributions. $25 per week, $1,300 per year. At 8% over 30 years, approximately $196,000. Total contributed, $39,000. Growth from the market, $157,000. $50 per week, $2,600 per year. At 8% over 30 years, approximately $392,000. Total contributed $78,000. Growth from the market, $314,000. $100 per week, $5,200 per year. At 8% over 30 years, approximately $783,000. Total contributed $156,000. Growth, $627,000. The pattern is consistent across every amount. The market's contribution to the final number dwarfs the investor's contribution. By year 30, $4 to $5 of growth exist for every dollar contributed. The investor's job is simply to start and to stay. The first investment is the most important. Research in behavioral economics consistently shows that investors who make their first investment, regardless of size, are dramatically more likely to continue investing than those who do not. The first purchase establishes identity. It creates a tangible relationship with the portfolio. It turns "someday I should invest" into "I am an investor." A $50 first investment in XEQT inside a TFSA is not just $50. It is the identity shift that precedes every subsequent contribution. The misconception about returns. Many new investors believe that small amounts do not earn meaningful returns because the percentage return on a small base looks small in dollar terms. A 10% return on $500 is $50, which feels unimpressive. But that $50 is not the point. The $500 that generated it is the point, because next year it is $550, and the year after $605. The small amount grows into a larger amount that earns a larger dollar return, automatically, without any additional action. This is why starting small and staying invested is superior to waiting until you have more. The early years build the base. The later years are when the base generates the dramatic dollar returns. Your action step: pick a weekly amount you can invest without affecting your ability to cover essentials. $10, $25, $50. It does not matter which. What matters is that it is real, it is consistent, and you start this week. Write the number down. That is your starting amount. In 2010, starting to invest with small amounts in Canada was genuinely difficult. Minimum account balances were common. Commission fees on trades could eat 10% to 20% of a small investment. The paperwork was intimidating. In 2026, every one of those barriers has been eliminated. Here are the 3 platforms best suited for Canadians starting with small amounts. Platform 1, Wealthsimple, recommended for most beginners. Wealthsimple Trade is a commission-free brokerage app available on iOS and Android. Zero commission on both buys and sells. No minimum account balance. TFSA and RRSP accounts available. Fractional shares available, meaning you can invest exactly $25 in an ETF even if one unit costs $100. The interface is clean and simple, designed for people who have never invested before. Setting up an account takes approximately 15 to 20 minutes. Funding via Interac e-transfer is typically available within 1 business day. For small amounts, Wealthsimple is the most accessible entry point in Canada. Zero commission means every dollar invested goes to work, not to fees. Platform 2, Questrade. Questrade is Canada's largest independent discount brokerage. ETF purchases are commission-free on Questrade, meaning buying XEQT, VFV, or VDY costs nothing. Sales carry a small commission, $4.95 to $9.95. Minimum initial deposit, $1,000. Questrade has a slightly steeper learning curve than Wealthsimple, but offers more features, more account types, and is slightly better for investors who plan to hold both Canadian and US-listed ETFs. For beginners starting with less than $1,000, start with Wealthsimple. Once the portfolio reaches $1,000 to $2,000, Questrade becomes a worthwhile option for the expanded features. Platform 3. Wealthsimple Managed, CT, Robo-Advisor. For Canadians who want to invest without making any investment decisions at all, Wealthsimple's managed portfolio product automatically invests in a diversified ETF portfolio based on a risk questionnaire. Management fee: 0.50% per year on balances under $100,000. Higher than buying ETFs directly, but lower than any mutual fund, and with zero decision-making required. For someone who genuinely cannot decide what to buy and would rather not think about it at all, the managed product is a legitimate starting point. The 0.50% fee is affordable on small balances. The bank brokerage option: all major Canadian banks, RBC Direct Investing, TD Direct Investing, CIBC Investors Edge, BMO Investor Line, Scotia iTrade, offer self-directed investment accounts. They typically charge commissions of $6.95 to $9.95 per trade. On a $25 weekly investment, a $9.95 commission represents a 39.8% fee on each purchase. This destroys the math entirely. Bank brokerages are not appropriate for small regular investments. Use Wealthsimple or Questrade. Your action step: download the Wealthsimple app today. Start the account opening process. You do not have to fund it immediately. Just start the process. The account opening takes 15 to 20 minutes and creates no obligation. Here is the vault from the opening. The account that turns $25 per week into something life-changing. Tax-free. The tax-free savings account. The TFSA. Every Canadian aged 18 or older has access to one. In 2026, the annual contribution limit is $7,000. If you have never contributed since your eligibility began, your cumulative room may be as high as $109,000. Here is what makes the TFSA the single most important account for a beginner Canadian investor. Everything inside grows tax-free. Dividends, capital gains, interest. No tax on any of it, ever. Withdrawals are completely tax-free. At any age, at any time. No forms to file. No tax owing. The money comes out exactly as it went in, plus every dollar of growth, completely untouched by the CRA. No impact on government benefits. TFSA withdrawals do not count as income, meaning they cannot affect GIS, OAS, child benefits, or income-tested credits. You get the contribution room back. When you withdraw from a TFSA, the contribution room is restored the following January 1st. It does not disappear. Now let us run the TFSA math on $25 per week. $25 per week equals $1,300 per year. TFSA invested in XEQT at 8% annualized return. After 10 years, approximately $20,000, tax-free. After 20 years, approximately $64,000, tax-free. After 30 years, approximately $161,000, tax-free. After 40 years, approximately $430,000, tax-free. Every dollar of that growth, $429,000 in growth on $52,000 in contributions over 40 years, is completely tax-free. In a non-registered account, a portion of that growth would be taxed each year as dividends or capital gains. Inside the TFSA, zero. The same $25 per week in a non-registered account. Assuming a 30% effective tax rate on annual returns, the same $25 per week over 30 years produces approximately $118,000 instead of $161,000. The TFSA adds approximately $43,000 in after-tax wealth from the same $25 per week, purely through the tax-free advantage. Over 40 years, the TFSA advantage grows to approximately $130,000 more than the same investment in a non-registered account, from $25 per week. The most common beginner mistake: opening a TFSA at a bank and leaving the money in the savings deposit paying 2%, or worse, 0.5%. The TFSA is a container, not an investment. What you put inside it determines the return. A TFSA holding cash earns almost nothing. A TFSA holding XEQT earns the market return, tax-free. Open the TFSA. Put XEQT inside it. That is the formula. Your action step: open a TFSA inside your Wealthsimple or Questrade account today. Check your available TFSA room on CRA My Account. Make your first $25 to $50 contribution. Then buy XEQT. The entire process takes less than 30 minutes. Here is the question every beginner gets stuck on, and the answer is simpler than almost anyone expects. What should I actually buy? For most Canadians starting with small amounts, the answer is one ETF, specifically XEQT. XEQT, the iShares Core Equity ETF portfolio, is a single ticker that owns approximately 9,000 companies across global equity markets. U.S. equities at 45%, Canadian equities at 25%, international developed markets at 24%, and emerging markets at 6%. MER, 0.20% per year. One purchase, 9,000 companies, every major economy. 0.20% annual fee. This is not a simplified version of sophisticated investing. This is what sophisticated investors, including institutional fund managers, do at their core. Own everything, pay almost nothing, stay invested. Why not individual stocks? For a beginner investing $25 to $100 per week, individual stocks introduce concentration risk that is not compensated by higher expected returns. If you invest $25 per week in a single stock, and that company underperforms or fails, your entire investment suffers. With XEQT, the failure of any single company is absorbed by the other 8,999. No single company's failure can meaningfully harm the portfolio. Additionally, stock picking requires research, ongoing monitoring, and conviction about specific companies. For a beginner, that cognitive overhead is a barrier to starting and staying. XEQT requires none of it. Why not just VBAL or a balanced fund? For investors under 40 with a long time horizon, the bond allocation in a balanced fund like VBAL acts as a drag on returns. A 28-year-old investing $25 per week does not need the stability of bonds. They have time to ride out market downturns. XEQT's all-equity allocation is appropriate for young investors with 20-plus-year horizons. If the volatility of 100% equities is genuinely uncomfortable, VBAL, 60% equities, 40% bonds, 0.24% MER, is a legitimate alternative. It will produce lower long-run returns in exchange for smaller drawdowns. Alternatives for Canadians who want U.S.-only exposure. VFV, Vanguard S and P500 ETF, tracks only the USS and P500 at 0.09% MER. Historical returns have been slightly higher than XEQT, but with less geographic diversification. Many Canadians hold both, XEQT for global diversification and VFV for additional U.S. tilt. For a pure beginner with one account and $25 per week, XEQT is the right single holding. It is diversified, low-cost, and requires zero ongoing decisions. The buy and hold discipline. Once you have bought XEQT, the strategy is to hold it. Not to sell when the market drops. Not to switch to something that performed better last year. Not to add more complexity as the portfolio grows. The S&P 500, which makes up 45% of XEQT, has recovered from every single correction in its history. XEQT's globally diversified structure means it has even broader exposure to the world's economic recovery mechanisms. Buying XEQT and holding it through market volatility, continuing to buy on the same schedule regardless of what the market is doing, is the strategy. It is not exciting. It is the one that works. Your action step. Search XEQT on your Wealthsimple or Questrade app right now. Look at the current unit price. Calculate how many units your starting weekly amount buys. Place the first order. That is all. Here is the part most beginner investment content skips. The system that keeps the investment going after the initial excitement wears off. Because the first purchase is the easiest. The second, third, and 100th, made during market volatility, during a bad month, during a life event are where most beginner investors fall off. 3 habits prevent that. Habit 1. Automate everything. Set up a recurring weekly or monthly transfer from your bank account to your Wealthsimple or Questrade TFSA. Same amount, same date, every period. No decision required. Then set up a recurring buy order for XEQT on the same date. Once this is done, the investment happens whether you feel like it or not, whether the market is up or down, whether you had a stressful week or a great one. The automation removes the decision, and decisions are where most investors go wrong. Dollar cost averaging, investing the same amount on a fixed schedule regardless of market level, means you buy more units when prices are low and fewer when prices are high. Over time, this smooths the entry cost and consistently outperforms trying to time when to invest. Habit 2. Increase annually. Every January, or every time your income increases, add to your automated contribution, even $5 per week more. The compounding on incremental increases is powerful over time. A Canadian who starts at $25 per week at 22 and increases by $10 per week every 2 years, from $25 to $35 to $45 to $55 and so on, reaches approximately $1,200,000 at age 65 at 8% annualized return. Not from a large starting amount, from small, consistent, gradually increasing contributions over 4 decades. Treat every raise as a contribution, increase trigger. Send at least 50% of every after-tax raise directly to the TFSA auto contribution. Habit 3. Stay out of your own way. The primary risk to a beginner investor is not market volatility. It is their own reaction to market volatility. Studies of retail investor behavior consistently show that the average investor earns significantly less than the funds they invest in, because they sell during downturns and buy after recoveries. They systematically buy high and sell low. The antidote: check the portfolio quarterly at most. Do not watch financial news and immediately open the investment app. Do not interpret a 10% market drop as a signal to sell. Interpret it as a sale, and, if possible, buy more. Implement a personal investment policy statement, a 1-page document you write during a calm moment that states your investment objective, your contribution schedule, your chosen ETF, your rebalancing rules, for XEQT alone, none needed, and your rule that you will not sell unless your life circumstances change fundamentally. When the urge to do something, sell, switch, reduce, arrives during a volatile market, you read the statement instead of acting. The Beginner Complete System, Wealthsimple TFSA account, XEQT as the sole holding. Weekly auto transfer from bank, $25 to $100. Weekly auto buy of XEQT on same date. Annual contribution increase of at least $5 to $10 per week. Quarterly portfolio check, no more. Written investment policy statement, read before making any change. That is it. That is the entire system. Every component is free to implement. Every component takes less than 1 hour to set up, and if followed, it will produce outcomes that beat the majority of professionally managed Canadian portfolios over any 20-year period. Your action step: set up the automatic transfer today. Even $25. Even $10. The amount matters less than the automation. Once the system is running, it requires almost no attention, and that is exactly the point. Let's come back to where we started. The biggest lie in Canadian personal finance: you need a lot of money to start investing. Here is what the numbers actually say. $25 per week. $1,300 per year, less than the cost of 2 takeout lunches per week. Inside a TFSA, invested in XEQT automated, left alone. After 10 years, approximately $20,000, tax-free. After 20 years, approximately $64,000, tax-free. After 30 years, approximately $161,000, tax-free. After 40 years, approximately $430,000, tax-free. From $25 per week, from a Wealthsimple account that took 20 minutes to open, from one ETF that owns 9,000 companies in every major economy on Earth. You did not need a large sum. You did not need to understand the market. You did not need to wait until the time was right. You needed $25 and the decision to start. The Canadian who starts today at 22 with $25 per week and never increases it retires with approximately $590,000 at 62. The Canadian who waits until 32 to start, with the same $25 per week, retires with approximately $257,000 at 62. The cost of the lie, $333,000. Do not pay that cost. Open the account. Open the TFSA. Buy XEQT. Set up the automation, and then leave it alone. You are not too young. You do not have too little. You do not need more time to prepare. You need 20 minutes and $25.